you saw Batman, new Batman?
No, but I'm definitely going to see that. I want to real bad. You know, I'm a sucker for comic book stuff. And DC has done such a horrible job with building out their universe. It pales in comparison to what Marvel's done. Disney needs to purchase that. The problem is that I believe AT&T owns the license, or I guess licenses from whoever the end owner is of all the DC stuff. Do you know the difference between the DC universe and the Marvel universe? Okay, I'll send you a Wikipedia link. Think all the Avengers. You know what the Avengers are, right? Okay, that's we'll stop there, Brett.
I don't watch any of those movies. You know my thoughts on movies. They have to be realistic. And so once you start giving superpowers out, not too realistic.
Hold on, wait. Veronica, you can just use this only. Let's go back to that. Brett, what's your one? What's your requirement for movies? They have to be
realistic.
What's your favorite movie franchise?
Fast and the Furious.
Yeah.
Up to like number 6 or something.
Oh my Lord. I need realism. I need a tank falling out of an airplane that gives birth to a sports car, that gives birth to a hot rod, so then Vin Diesel can land under a semi and rob someone from Japan.
Look, once they added CGI graphics and all this other stuff in there, it certainly jumped the shark. But the original couple of them did not have that in that. And they were fantastic.
None of that? No, they didn't have any of that. No, they don't have Tyrese and Paul Walker, rest in peace, flying off a ramp made of crab cages in the Keys, landing on a yacht 100 yards away from.
Have you ever tried that?
No, Brett.
Maybe it could happen. Welcome to Talk Your Chart. Brett Horowitz here with Marco Segrera. The first topic, let's jump right in, Marcos. The first topic that we want to talk about came to us from a client who sent us an email saying, hey guys, love your Talk Your Chart. Would love if you could mention and discuss a series I bonds, inflation protected bonds. So I want to first say that while we thank our fans for listening in, this was not my mother that said this. This was an actual client that said this.
It was my mom.
Even though our moms are big fans of the show. So we've talked in the past about chips. We've talked in the past about which are Treasury inflation protected securities, right? Treasury inflation securities that you can buy online. We talked about stocks being some kind of a protection against inflation because companies can pass on their earnings and pass on their higher cost of goods to the consumer. So today we're going to talk about inflation Series I bonds. Marcos, what do you know about Series I bonds? Anything?
I know that a lot of people are asking about them because they're paying way more than everything else is. And they ask how much of their money they should invest in these Series I bonds. And I'd say it better not be more than $10,000.
Well, I think, yeah, that there's a few things I'm going to throw in cold water over Series I bonds, but I think it's sort of inflation in its purest component because you don't have any risks of interest rates. You don't have any risks of the market going down. It's simply you put your money into the Treasury Direct's website, you buy it, and you get that interest rate for 6 months, and it is what it is. Right now, it's over 7%. So everyone looks at it and goes, oh my God, this is amazing. But I think there's a couple of downsides that we need to talk about as well.
Okay.
So I wrote an article for Yahoo Finance a few weeks ago talking about some of the things that I was not as excited about. You mentioned one of them, the $10,000 limit. To me, that really provides less value than I think I'd want to get, because if these things paid out, as we see in this chart here or this table, as of November 1st, they were paying out 3.56% for a 6-month window. So that translates to over a 7% return for 12 months. 7% on $10,000 is $700. Like, that's great. But if we go back a year ago, they were paying out 0.8%. So you double that, that's $160. Like, I guess if someone wanted to do it, I wouldn't bash them. But for me, it's a lot of work to do this and monitor this and then have to pull it out later on when the rates drop, and just for a couple $100.
It just depends who you are. If you're the person hunting for like credit card points and airline miles, and you will spend 3 hours to save a $500 ticket on a plane, these are built for you.
Exactly.
Because they don't move the needle, but man, they'll make you feel good because most people don't know about them. So when you say you earn 7% on some bond and you fail to mention the fact that maximum amount you earned was about $700 over these next 12 months, then you feel good. But how much have you moved the needle? Yeah.
Right. Yeah. If you're talking about, I can put in $100,000 or more and, get 7% for the next 20 years, count me in all day. But, for someone who chases the CDs, like you say, or other things, like they're not that great. You have to keep your money in there for more than a year before you can take it out. So you're not allowed to just put it in and wait 6 months and pull it back out. You got to be taxed on the interest. So that will bring down your return a little more as well. So, I said, if someone wants to do it, I've got no problem and don't fault them. And I think it's a good idea. But to me, they're not as exciting as they are at the surface.
Yeah. And these things have been around for as long as you could remember, right? Do you know if they were born before tips or after tips?
You can go on the Treasury site and they've got rates going back decades. So I don't remember the exact starting point. They have a fixed component and an inflation component. Right now, the fixed component is 0 and your entire return is this inflation component. And come May, this will get reset. So May, it probably is another high number. You're probably looking at another 3 to 4% figure if we had to guess what inflation is.
Yep.
But come November this year, maybe we're back down to the 2s or 3s.
Yeah, who knows? And now with what our next topic we'll touch on, it doesn't look like the inflation tailwinds basically are going to get any easier with what's happening with oil due to the war and the conflict in Russia-Ukraine. Okay.
Well, the one interesting thing I read recently was that most of, while Europe is having high inflation as well, it's mostly due to supply issues. They're not seeing the demand because I guess the EU and the ECB did not send out as much money as the US government did. Whereas our inflation is half due to supply issues and half due to demand issues. And maybe demand comes down on its own just because interest rates, because oil is so high, people have less money to spend on other things.
Yeah, it's funny. When you get rising oil prices, it's usually inflationary in the short term and then deflationary on the back end because the consumer, which makes up the vast majority of especially US GDP, they get tame. They don't demand as much. And that's where you get your aggregate demand kind of rolls over. That plus rising interest rates, which we know are going to happen. We're just not sure exactly to what magnitude and the velocity, how quick they're going to actually raise rates. That all spells, again, it spells slowdown, right? It spells slowdown, which also honestly makes sense because we've been hitting GDP figures that are year over year look like we're an emerging market, right? We're not supposed to grow between 7 and 12% every single year, right? So it makes sense.
Well, you've talked about base effects too. And so These are the comparisons of year ago to now. And so there was an article this morning in the Wall Street Journal about how if car prices remain where they are, if rents remain where they are, even rise a little bit, that's going to take a lot out of the inflation number just because they're compared to now a year ago where the numbers were so high.
Yep. Speaking of cars, I bought out my lease. I'm one of those people. I could make like $10,000 if I sold my lease, but instead I'm going to overpay for car insurance. So my 16-year-old to be can drive a vehicle.
Oh, you're a good dad.
I digress. I didn't want to do it. Stepmom and mom made it happen. Okay. So moving on.
Last thing, just want to say, so coming back to Series I bonds real fast, I think it makes sense for someone who wants pure inflationary protection. It's not that exciting to me given the dollar amount. It's not something I'm going to put my money into just because of the limited amount that I could do with it. But if you want to avoid all the risks of Treasury inflation protected securities, of owning stocks, of gold, other things that maybe have some inflation component to them, but then have another risk on the side, this to me is the purest form of inflation protection.
Yeah, precisely. Yeah, I think it's not going to be a bad idea for anybody to take $10,000 and keep them in there. And that can be their $10,000 hedge against surprise bouts of inflation over time.
Yeah, for sure. Okay, moving on to more serious topics.
Yeah, so as we get onto the geopolitical stuff, I long missed the simpler days of talking about inflation and whether or not it was going to be transitory. As now quickly, and this speaks to a lot of what we go through with clients about headlines. There's never a good time to invest. COVID hit us, then supply chain, inflation. And just as the pandemic feels like it's getting more endemic as mass mandates roll off, what do we get now? We get geopolitical risk, and we see all these things that you kind of talked about for the last several years, probably since 2014, right, since 2008. This has been an item from a geopolitical risk standpoint, and finally it pops now. So again, it's back to the idea of, sure, it can happen, but when it happens, who knows? So the first chart that I wanted to show, and I broke the rules as usual. I have more than one chart. We'll see how many we get to. The first part is one that surprised me, to be honest, but it basically is showing us that war impacts stocks less than you think. And that's not to remove the human impact of these things, right? I don't think anyone is looking to Brett and Marcus to talk about the humanitarian aspects of this. I think we're just approaching this from a market standpoint. And when you do that, there's the magnitude of the impact is much smaller than I thought it was. And what this chart is showing us is specifically the S&P's response to geopolitical events going back to the 1940s, right, which is Pearl Harbor, all the way through the Kennedy assassination, Cuban Missile Crisis, and anything you could really think about.
But
And
Marcos,
ultimately
this chart, to me, I'm also surprised at the difference between the top and the bottom, right?
Yeah.
So I don't want to discount the fact that this could be a 300-day event or a 700-day event or something that we haven't seen before, because it's not as if everything is 1 or 2 days. You've got a wide spread between things that to me were not that important, that lasted a long time, and things that were very important that didn't last a long time from the S&P standpoint.
Yeah, I totally agree. And what that really boils down to is an average recovery of 43 days and an average amount of time to the bottom of 19 days, which just sounds like not as bad as I thought it would be. But again, ultimately, you still feel the fear of, man, this is not going to get better anytime soon. And ultimately, what could your downside be? Well, if we're talking tactical nuclear weapons and all that type of stuff, well, yeah, that's no good for anybody. Ultimately, what's it going to matter how you're invested if we get to that point? So since this is a probabilistic exercise from an investing standpoint, we have to do just that, right? And stay consistent to the plans that we put in place. So let's frame something real quick, Brett. So we've seen this, how markets have reacted to these geopolitical events. Let's look at the broad markets now since February 24th of this year. This is through end of yesterday. So this is through March 7th. By the time you're all seeing this, things could be much worse, not change or much better, who knows? But you'll see that bonds have done their job and they've held their value. US markets fallen about 2.5% since then. And then obviously a lot of weakness in international markets, given that this is happening in Europe's backyard.
Well, I was surprised to read that before yesterday happened, because yesterday, we're recording this today on a day where yesterday market was down 3%. Before yesterday, the markets were actually positive from when Putin first invaded Ukraine. And I think what it tells me is that markets are more focused on the, number one, the economic impact, not necessarily the human impact, which is me far worse. Because I think somebody wrote in an article the other day that this is the equivalent of Florida and Nebraska fighting each other, right? Like it's just not a very big impact, even though it does affect wheat and palladium and oil and other things. But also the fact that, the markets were up over this time and that we're fearful more of Powell than we are of Putin, right? That's where the real worry has been this first few weeks of the year.
Yeah, agree. I think this went quickly from, oh my gosh, a war between Russia and Ukraine to, man, how is this going to impact what the Federal Reserve is going to do with interest rates? And that's what the market is looking to. There's uncertainty, sure, about Russia, Ukraine, but now there's even more uncertainty about what Powell is going to do with rates. It went from more than likely a 50 basis point increase in March to most likely a 25 basis point increase. But then what does this have people thinking about? Ultimately, stagflation. You and I talked about this a couple of days ago, which is that idea of you get reduced economic growth, so GDP is falling, but inflation is rising. So it's that perfect storm of pain, which I've never lived through a stagflationary period. I don't know too many that have. It almost to me sounds like a textbook term that you talk about, prognosticate about, and never really comes to pass. But it drives fear into markets. And ultimately, we just saw the numbers of since February 24th, not much pain. But now broad markets off their all-time highs. We have emerging markets down 25%, US market down 13%. So we're in correction territory and in bear market territory in certain places.
But the unique aspect of this is that it brings back two thoughts that were sort of off the table at the beginning of the year, which is maybe rate increases are much more dovish. Maybe we only have a handful of them. And like you said, less impactful than the huge step ups of 50 basis points over and over again. Maybe we only have 3 or 4 25 basis points because the market sort of corrects itself for the demand. And also maybe there's money that gets thrown at the situation, right? We saw what money did. If inflation is going to come down naturally throughout the year. And I was reading some people are saying below 2 or 3, below 3 or 4% by the end of the year, which is a pretty fast rebound. But if inflation comes down, the Fed and the government can throw some money at it. And, that's what they did in 2020 with COVID. That worked out really, really well, although it had a side effect now with higher inflation. But, that's always the wild card of what they could do is just stimulate the economy that way.
Here's what I'll tell you. So what about this scenario? You get a Fed that's raising interest rates, right, into all of this. Now, if they don't raise as fast, ultimately why they're raising rates? So they can lower them later. If you raise rates now, what you end up doing is giving yourself room on the back end. Let's take this to its natural historical course. When oil does this, what happens? I'm not calling for this, but a recession many times is around the corner. If we get to a recession, what can we do? You said one thing, print more, inject more liquidity, and you drop rates. In 2018, when this happened, right? Powell raised rates how many times? Yeah, X amount of times.
It doesn't make sense to raise rates then just to lower them.
That's what happened in 2018.
Well, I know, but they made a mistake. Let's have them keep rates lower and not raise as fast, because if employment is already at maximum where it needs to be, and if the economy is already not
GDP is crashing, yes.
If the economy slows down on its own, we don't need to raise rates 6 times just to lower them later on. We just have to raise rates less. I'd like to see them do that.
Yeah, I don't disagree with you, but it still requires some level of raising rates. So yeah, I think hopefully, and again, here's the other reality. You have, unfortunately, the politics of it all. No one wants high inflation going into midterm elections, especially if you're part of the Democrats.
But no one wants high interest rates either.
Oh, I agree, but we know we're not going to end up there, because what's high, right? Is high a 2%?
Yeah, it's all relative. Rate? Right, it's all
relative. So hopefully you put some downward pressure on the magnitude and velocity of interest rate rises, but you still need to get back to, they're so behind the curve that they need to get something up. Because ultimately, if we do end up in recession, we're going to cut rates again. And you can't cut from here. So we need to raise rates. Now, I think that's why the market isn't flailing as much as possible. And I think we're also kind of waiting for what's the off ramp for Putin. Because I don't think anyone can think of a constructive off ramp for Putin. We can just think of all the unanswerable questions of whether this dude's trying to follow Peter the Great, his beloved czar that I think it was in like 1790 or something like that. Peter the Great's big career defining win, his big W, was in Ukraine. Well, look, what if Putin at 70, like this is his retirement plan?
I've got a Spain trip coming up end of April, early May. Like he needs to stop where he is. And this thing needs to end.
I know. I agree.
And for all the people that live there, this needs to end soon. He needs to let them leave the country if they want to, stop attacking people. But it's funny, you and I were talking about, changing gears really quickly, about our inflation estimates last episode. And when we think it's going to come down, none of us factored in, Putin invading Ukraine. Like that's the difficulty. We're going to get to the end. And maybe I was right, maybe you were wrong, or vice versa, but it wasn't for the reasons we gave.
Not at all. And this is why prognostication and making meaningful bets based off what you might think is tough. Risk is what's left over after you thought of everything.
I have a client that says, just because you go through a red light and didn't get into an accident doesn't mean it was a good decision.
Absolutely. You can be right and still be stupid. We all know this.
Yep.
All right, man. Hopefully this stuff cools down.
Yeah, cooler heads prevail. We pray for everybody over there.
Thank you, BH.
Take care.